Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of August 17th, 2025. And in this week's episode, Viper and I are going to take a look and share something interesting that's been happening on our radar. Each one of us has kind of picked something. Mine is going to be a little bit more of a don't ever give up. I want to circle back and take a look at a long-standing trade just to show you what that perseverance can get you when you trust your plan and you trust what you have going. Just stick with it and hang in there. And Viper is going to give a little bit of an update on things that he has been looking at and how things have been going for him. And he, spoiler alert, is a little bit on the prowl for some other strategies to kind of tinker around with. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. Viper earnings season is well underway. In fact, there's probably not a ton of earnings time left out there. It kind of comes and goes, but don't worry, it'll be earnings season soon enough. And I'll say so far, this earnings season hasn't gone as swimmingly as I would like. I've definitely hit a couple of good winners. I've had to roll a couple trades, and I could probably go on many different approaches and talking through some of that. But in this episode, I kind of want to zero in on one particular trade that I actually started back in May of 24, just to kind of show how some of that stuff plays out. Because as I went into this earnings season recently, the first 2 weeks, I think, turned really, really great. I would think I was batting like 75 to 85%. And then lastly, there was probably keeping up close to a decent win percentage, but every once in a while in earnings, you just get this blast of a boom, kind of a gut punch where it really goes against you. And that can be incredibly discouraging. In fact, I found it really discouraging a long while back, the first few times that I got it, and it really kind of made me want to throw in the towel and a lot of times. But so I decided to take a look back because one of those long-standing trades kind of surfaced again as far as maybe the opportunity to finally close it out, and it's in DELL Technologies, and that's what I want to kind of talk about a little bit here, diving into that. But before I hop to that, Viper, what's been happening in your world as far as earnings trades? Have you been putting stuff on, and how's that kind of panning out for you?
Well, mixed. So a couple of things have been happening. I have been putting trades on. I do have a positive win streak, not streak, but ratio, win percentage. But there was a doozy hidden in there, a big loss that I took so far, and that was on I think it was Airbnb. I think it was Airbnb, which did not go well. I can't remember. Was that one of yours?
I don't think I played Airbnb on this most recent earnings.
So that one kind of blew up for me, and it wasn't like it didn't like, so the account, so I'm still using, like I talked about in previous episodes, I'm still using that $1,500 account. There was a drawdown on that account at the end of last earnings season, which we kind of talked about before. So when this Airbnb trade blew up, it didn't nuke the account or anything, but it was just, it was a little depressing because it was, it's really, one thing I'm finding is it's really hard to be consistent with position sizing in this particular strategy. And so that does mean that I do sometimes have trades that are $200 debits versus $100 debits versus I don't go any higher than $250 debit. So this was one of the higher end ones that blew up. And so it was just that, I mean, and some of this is speaking directly to that whole emphasis of position sizing and consistent position sizing, which this strategy is just not really allowing as much as needed, because it's this juxtaposition of, for the strategy to work, you need the laws of large numbers and just be cranking it out. But then also, in order to do that, you have to break this position sizing rule. And so the breakdown of this particular trade, it did, like I said, it didn't nuke the account or anything, but it just drew down several wins all at once. And so that's obviously pretty defeating to kind of erase that work. And so that was factor one that called into question how long I want to pursue this. And condition number two is that it's just a really busy season at work right now. And so I know you just did a video about this, time spent on this activity here. And it's just the time is not there right now. And I do enjoy the screening and of earnings season and things like that, but I'm just not able to put the focus on it that I want to. Which then ends up yielding or feeling like I'm rushing trades. And that's not a bad thing, because the more familiar you are with your strategy, with your plan, the more you can rush through things and just throw orders in because you understand the whole thing of it. But I'm not quite fully there yet. And there's still things I like to soak in, details I like to suss out about particular trades that I'm just not able to do right now. And again, the strategy is so time bound. It's really hard to find that time. So that has combined to a pretty mixed experience so far this earnings season, and is also motivation for some of the other explorations that we're going to cover here.
Yeah, Viper, I think I know what you mean when you kind of have some of those trades that really just kind of discourage you, and they can really offset when you don't have that position sizing set there. I will say that one of the things that I did discover back when I did a lot more defined risk trades, one of the things I didn't like about them was the fact that they were very, very hard to manage. Means you basically put that trade on and it was either a winner or a loser. There was really not much in between. So you either closed it out early for a smaller profit, or you held on to the end hoping for the full blown profit. But if you flipped over that trigger line of profit and loss, there was no real like, oh, let's roll it out to next month. And I think that's just inherent in defined risk. And that was one thing I really liked about undefined risk, was you could really kind of take those into perpetuity. There really wasn't an end to them necessarily. Now, you could have an end in your strategy, but you always in premium selling can roll it forward for a profit, almost no matter how much breached that you are.
Yeah, I mean that's definitely part of this situation. I'm experiencing the same thing, and it's specifically with the calendar calls on earnings. Everything moves so fast. And I kind of talked about this before, so it was kind of foreshadowing of it's, some of it didn't change. Where, post earnings event, like, I mean, the calendar call specifically, because it is that defined risk. And it's the same thing that we also, I think, discussed previously, that it's a very narrow window. I put as many edge pieces in place to expand that window, much beyond what a calendar call would normally allow. But it is still that friction feeling of, if I put the trade on one day and then earnings happen, and then the next day I'm really busy and I don't have a chance to go check where we're at, there's many times the window is missed. The window to get out at the best available price and profit was missed because things are still volatile and it went up and down or whatever. So one of the things that's drawing me to the strategy we'll go to in a minute is it is defined risk, but there is a little bit more you can do with it. But to your point, even the strategy that I'll talk about eventually is not the kind of strategy that you can have this really long term, grind it out until it works, which you do with your undefined risk plays. So I feel like even though in my two constrained plays, this one that we'll get into is very much more malleable. It doesn't compare to what I believe is your particular take on what something means when it is very flexible.
Yeah. So I'll kind of pull over and let's talk a little bit about DELL. Because to me, this is a great example of something that went sideways on me, but I hung in there and I said, nope, this is once you get assigned, that assignment is a thing that's going to happen. And then you flip over to selling calls against it, looking to get assigned away. Now, it's very possible that you're going to drop so much that selling calls just can't be done. And that's kind of what you'll see in this chart. So let me go ahead and flip over to the DELL table, let's call it, that I put out there. I'm not going to pull up a chart or anything like that. I'll talk through some of that. But what I want to call out here is this trade started in May, the end of May of 2024 as an earnings strangle. And so I put a strangle at 150 put and 205 call. So back then I'd have to go check, but I would say DELL was probably trading somewhere in the middle of 150 and 205. They had just terrible announcement that came out there, and the stock just absolutely nosedived south of 150. So I collected $14.01. I sold 3 strangles at $4.67 a piece. And like I said, it nosedived. So I closed out the put side for a loss. I let the call expire worthless because there was no way we were getting above 205. I mean, this thing went south of 150. And so that's my close cost there of those 3 contracts. Cost me $5,100 to close. So if I'd have just walked away right then and there at the end, I'd have been down $3,700. Now the buying power was on the vicinity of 5,500 or 5,000, something like that, I believe. It expanded because I ended up getting assigned. And so roughly for this trade, you probably can factor about a 6.5K to 7K buying power hit. But what I did was I rolled that put and I rolled it forward to the next monthly expiration. And I rolled that forward for $17.43. So, we're probably $10 to $15 in the hole here. And that's, I'm selling all of that back. And in intrinsic value because we're in the money. And I end up getting assigned. So yeah, I collected $5,229 from that, but I ended up getting assigned at $150 a share. Now I kept every penny of that $17.43 I collected by 3, but I had to fork over the money to buy 300 shares of DELL at $150 a piece. So that's $45,000. Now I have margin accounts, and so that didn't really cost me $45,000. Some of it goes on margin, and basically that's where my buying power expanded to about $6,500 to $7,000 of buying power. So that's really the hit to my account on how much of that money I can no longer use in other trades. So it's kind of tied up. But it's not like I lost that $45,000 because the stock had value. Now, it was less than that because it was deep in the hole. I believe DELL got down into the 80s somewhere. While it was falling in June, I went ahead and sold a covered call quickly at 150. So I was assigned at 150. So I thought, well, let's sell the call at 150 because if I get assigned, then I don't really lose any money and I'll keep all this premium. But I was only able to eke out $2.60 for that times 3. and it just fell away. And so that was additional $780 I picked up. Now that expired worthless, and DELL kind of rallied later in October. So this is 5 months later, and I was only able to sell one covered call. So it rallied a little bit. I really was anxious to get some calls sold. So I factored in what my break-even price was. I said, you know what? I'll go ahead and sell a 145 call. So I did at $1.82 times 3. So I collected another $546. Now, we started getting close to expiration and DELL was rallying. And I'm like, oh my gosh, I don't really want to sign it at 145. So I closed out that $145 call and I rolled it forward and bumped up the strike back to 150. So that cost me $165 to do that. But I was able to sell 3 more covered calls at 150. So again, that was my assignment price. So if I got assigned, that $45,000 is a wash. I paid $45,000. If I sold at 150, I'd collect $45,000. So it's negligible. You can ignore that. So I collected another $15 there. Now that, again, DELL nosedived again from there, and I was able to keep every penny of that. It expired worthless. But you'll notice the next trade I didn't put on for DELL wasn't until August of this year, basically just last week. DELL has finally rallied back up. I think it's in the 140s, and I was like, great, I can finally sell another 150 covered call for very good premium. So I sold again for $4.64 times 3. I collected $13.92 now. Now, this is an open trade right now, and I can, hopefully I'm going to get assigned and called away. One thing to call out is while I was sitting there waiting, because I couldn't sell covered calls because it was too low below my strike, DELL pays a dividend. So there was 5 instances that a dividend payment was made for the 300 shares that I owned. So I collected $700 through all of those dividend payments. So if you look there and you add up all of my opens, all of my close costs, all of the totals, including all that stuff, you see a net credit that I've received of $6,283. Again, that's a buying power of about $6,500 a share. So over the course of about, let's see, May to May to August, so that's about 15 months time, I have returned 96% return on my capital. So remember that capital tie-up is that $6,500 of buying power, and I collected $6,283. So this trade is still going. It's possible I'll get assigned and this is how it will end, but it's also possible that I'll roll again. And this really just reminded me of stick with it. And this is something that is not really possible on defined risk trades. Now, the benefit of defined risk is you know exactly what your risk is and you don't have this buying power expansion. You don't get caught into assignment, yada, yada, yada. So there are trade-offs. For me, the fact that it's undefined risk allows me this ability to kind of keep rolling, keep collecting, keep at it. And yes, if you get assigned, okay, great. Now you have the shares, go ahead and collect the dividends and sell some calls against it. And you can see over the courses, if you divide that out by that return over those months, that's still about a 6% return a month. And 6% return a month is still over 70% annualized return in a year. So, you know, you might say this is peanuts. I don't know what you'll say. Maybe you'll say it's amazing. I'm not sure. But it just was a nice constant reminder as I went through this earnings season where I'm kind of getting beat up and battered on some of the trades not going my way. I won't say it was bad against me, but there were more trades that went against me than I would have liked. I want to win every single one. But I stuck with them. I'm, going to roll them. I'm going to manage them. And this DELL was just a really nice example of kind of what can happen when you stick with it, when you know over time what your strategy yields.
Yeah, I would also call out and encourage people seeing that, obviously to acknowledge the importance of all those lessons, but an additional lesson that I want to call out is it's why it's so important to know and discover and understand your personal personality and your trading style. And that's something that you can have preconceived notions of who you are, what you're going to be like, your emotional state and whatnot. But that's also, those are things that just come out by being in the market, by, touching real money and doing these things, because I know for me personally, the theory of that long game is spot on. It's it makes total sense, and it's amazing to see when it works out and whatnot. But I know for me personally, that's asking a lot of my emotional state to persevere that intensely through a trade. And it is the extreme benefit of options versus just buying and selling stocks or whatever, that you have those levers at your disposal, but you can't really start to trust them and lean into them until you, number one, understand them, and number two, know what your own personal tolerance is going to be. And so, again, that's just, I don't want to say beating a dead horse, because it's very much an alive and important horse, but beating it nonetheless, of just, be in, put money on the line, but do it carefully, do it structured, so that way you can discover these things without blowing up an account while you're in the training process.
Yeah, it definitely takes a while to get used to and experience to kind of go through it. And because the first couple times, your emotions really, man, like we've said in past episodes, the psychology of trading, it's a serious business. And if anything, that's one of the most difficult things to handle, not the actual technicals of stuff, but more the psychology and how it impacts your brain and how it impacts your kind of visceral reaction to things. But Viper, you kind of alluded to maybe searching for different things because you haven't been so happy with how some of your earnings have kind of panned out. What have you been looking at?
So this goes back to, I mean, even if I was still doing earnings as intensely as I would have liked to, because there have definitely been some, like I said, cherry of an opportunity in the earnings season this time. Regardless of that, I would still be on the lookout for this particular type of strategy. And that's because this strategy that I'm going to talk about it's not an earnings strategy. And so again, to complement that earnings season thing, there is a lull, like we talk about. And one thing I noticed after last earnings season, when we get into that lull, I don't feel productive with my account, and I don't like that feeling. I don't like not feeling productive, because bad things come from that, and bad things being in the form of forcing trades. In this particular case, at the end of last earnings season, it was forcing trades on, okay, there's 10 earnings this week, so surely there's a play here, and digging through these 10 earnings of these tiny companies nobody's ever heard of that are just horrendous order chains, options books, horrendous liquidity, and that's forcing a trade, and that's never a good idea. So this particular strategy comes from trying to find the year-round 365 strategy. And so essentially what we're going to talk about is I believe it's called a debit vertical spread. I mean, it's a vertical spread for sure. But I don't know if I would imagine those are separated as debit or credit, because you would normally take a credit vertical spread anytime you would deploy a vertical spread, right?
Correct. Your credit would be when you're selling the spread, and if you pay money for it, it would be a debit.
So this is a debit vertical spread where you are buying an at the money long contract. So you're buying that one. That's going to be more expensive. And you're selling short a short option contract, which is further out of the money. And so you create this spread. It could be put or call, either side. But your structure is we're buying right at the money, and then we're selling out of the money. So that creates a defined risk. It creates a directional play. I would say it's one of the most common types of spreads. So there's plenty of different ways to use it, plenty of different ways that it's deployed. But in this particular case, what was most interesting to me is the fact that as I've gone deeper into various option strategies and whatnot, and I mean, it's certainly a core piece of Sprocket strategy as well. I've started to summarize that the value for small traders like me, like Sprocket, anybody watching this, spoiler alert, we're never going to be big whales, big, massive institutions or whatever. We will always be small market participants. And that's really important, I think, to understand, because it's knowing your role, knowing, that this thing's going to move in all sorts of different ways and you're this tiny fish and you have to go with it or whatever. And where that's become really important to me is understanding that the value for a small fish is to spot market pricing inefficiencies or just market inefficiencies. And those will in theory, those inefficiencies will always exist. They might move to different areas, but when you have a market as big as the market, it's going to have so many big players. It's going to have so many small players that there will be pockets of inefficiencies that surface. And to be able to consistently see those inefficiencies and then lean into your superpower as a small fish, which is the fact that you can see small opportunities and jump through them. So I guess let's go ahead and jump into some of the data around this particular strategy and what that edge is. Because so far, this is okay, a vertical spread. Like, this seems, on the surface, it seems kind of counterintuitive. If I'm going to buy at the money, that means I'm expecting a certain direction. So why and buying a long option? I mean, that's a one-time transaction. There is literally zero consideration for further loss or this could blow up in my. No, you paid X amount of dollars, and that's it. That's your max loss is realized right away. And so the question should come up of why in the world would I want to now define my profit? Because my risk was already defined by just buying the contract. Why in the world would I want to define my profit by now selling further out of the money? Because that feels like now I'm kind of kneecapping myself, because as we can see in this chart here on Rocket, so $17, and I anchored, like I usually do on my charts, I anchor these lines to around where I opened this. Price was floating around $16.80 when I opened it. And so the skew, which is a part of this strategy, was in the call direction. And so so I took the at the money call in the call direction, which was $17 here. And so it would cross somebody's mind, okay, so I bought $17. I want the price to go up. Why don't we just stop there? Like, just buy the call and let it go. And that is a strategy. That is the lottery ticket, as Sprocket likes to refer to it in his premium selling strategies, that you're buying it and you're hoping it goes up, because when it goes up, you are leveraged seriously to your benefit as it goes up. So in this case, though, I paired it by selling this $19 call, which is around a 15 delta on the short side. So the reason you do that is because the inefficiency that we're capitalizing on here is this volatility skew. And so in this particular case, the $17 at the money was very fairly priced or even underpriced. And we'll go through a little bit of that, what that means with the volatility. And the $19 was very elevated in volatility and therefore potentially overpriced, or what we look for in selling strategies. So the point of this strategy is, if we can spot that difference, that skew, where the further out of the money is actually packing in more premium than it's supposed to, or than it normally does, then why don't we capture that, which now in turn gives us a discount in net term values, gives us a discount on that at the money long option that we bought. So now we have a discount on still a potentially long, or on still a directionally long position. And so just to realize what this, potential profit scenario looks like between these strikes, we have a max loss scenario, which is if we drop, far enough down here, both of these options, the long and the short, become worthless and we're at max loss. So it's whatever debit we paid to open the spread, that's our max loss. And there's an intentional gray area here, which I'll explain in a minute. And then as we move between $17 to $19, we start to increase our profit, because in this window, the long option is increasing in value because we are going deeper and deeper into the money on that long option that we bought down here. And so this window is our max increase in profits. Once we hit $19, the profit chart just becomes, it's just a solid, that's it. We max our profit at $19, and that's because of the mechanics of selling that $19. That $19, we're now above $19. That $19 call becomes in the money. And so now, it becomes, the covered scenario of the $17 one. So we capture that middle ground, and then we peak when we go over that. So the reason for this gray area, though, is because if we just naked bought this $17 at the money call, if we're $16.99, you are out of the money on the $17 call, and you only have your extrinsic value in that. But the fact that we sold and took that premium from the $19 means that we've lowered our cost basis, which means we can actually move around a little bit with that discount. There's a, mathematically, if we sold that $19 for 50 cents, then now our cost basis is $16.50, where that's our break even. But the reason I didn't want to put that hard defined on the chart is because that $17, remember, we bought that at either fair price or hopefully underpriced. And so there is this little wiggle room that I've noticed on a couple of these trades that I've taken already, where I'm actually below my mathematical cost basis. So let's just keep using that 50 cents. I'm actually below 1650. I'm at like 1640, but I'm still in profit. And that's because the $17 is actually elevating in its volatility, which is now raising its value. And it's kind of giving me even more of a little cushion. So that's the gist of the strategy. And I guess before I get into screening and kind of what I do to find these trades, I was taking a personal bet that this is definitely not something that you would be interested in, Sprocket. But I also wasn't 100% sure, because we're tying in some, premium selling and using that to our benefit, and it's a little sideways and up rather than a perfect directional play. So, is this a strategy you've seen before, heard of, or really not your jam?
Yeah, Viper. No, this definitely is a strategy that I've seen before. In fact, it's something that I've even considered dabbling in. And, I've always talked about selling premium, look for when volatility is overextended, look for that, sell the volatility, short the volatility. Everything is a mean reversion. It's a pendulum. We go back and forth. So if there is a trade to be made when you're overextended, there should be a trade to be made when you are underpriced, or basically when your volatility is extremely low, looking for that volatility expansion. And that is definitely a trade that's out there, where people are hunting down underlyings that have very low volatility, where they can buy the option very, very cheap, because that is a fixed cost. It doesn't expand on them. And then if volatility expands, the price of the option goes up. And if it moves in their desired direction, the price of the option also goes up. my personal take on that is I've always been hesitant to engage in that because of this small little monster called Theta, where Theta is constantly gobbling away at that extrinsic value. It is just an extrinsic value piggy pig, and it will gobble it up and eat it away. And then when that option is time bound and it expires, if you're not in the money, then you have nothing to show for it. And that's something where I would rather have the wind at your back, if you would, or Theta on your side, time on your side, where that's helping to gobble away the, what you sold. And so that's really where a lot of that is in my comfort zone, because I'm quite frankly just a little bit afraid of that Theta monster.
And that's a good point on the Theta monster. So some things about that. One thing I forgot to mention, which is really pretty critical to this strategy, is is momentum. You need to, and I'm not gonna cover any momentum surfacing strategies, because that's just a whole other topic. But one way or another, critical to this strategy, you need to be able to look at a chart. And I mean, that's a rabbit hole that you should go down, is how to spot momentum and all this other stuff. But you need to know the trend direction, and you want to take this trade into the trend direction, because that is, again, adding to your potential edge here. So that's one caveat that I should have mentioned. Details of it we could get into in a future episode, but so trend direction on Rocket here was up, and so that was why I took the call. Now to the Theta Demon, if I get rid of these bubbles here, just so we can see this better, this is actually an active trade. That the blue line here is my expiration. It's in 2 days. So we are officially in max profit scenario here. And to be honest, I am not mad about this 66 cents. That, I'm potentially missing by being capped at $19 here, because to your point about little Mr. Theta Demon, for the most part, so these trades typically I do 10 to 15 days to expiration. So Theta is rapidly decaying, but it is also already burnt off a decent amount. But also because we're buying that at the money call, there's intrinsic value in 95% of this price action since I opened the trade. And so that significantly combats that Theta Demon. And if the price had not spiked recently, or before we get to expiration, if the price actually falls down below $19, now I have a discounted $16.50 break even long call option, and so I can, trend direction should be holding, because again, that is a critical start point. And so I don't want to say we've completely taken out Theta, but we've at least leaned into how to best mitigate it by taking the trend direction and taking a trade that goes into the money fairly quickly in theory.
Yeah, Viper, and what you called out there is actually very, very important, because a lot of times when people buy options with low volatility, they're buying very far out of the money options. So what you're doing is you're buying an at the money option, which means if this moves at all in your favor in the direction you think it's going to move, you're going to start building in that intrinsic value in the pricing of the option and the cost of that. And intrinsic value is like bulletproof glass that the Theta monster can't come through. It's the flashlight that you keep by your bed to keep that Theta monster under your bed, where it cannot gobble into that intrinsic value. And so what you're calling out there is saying, look, I bought this at the money. I'm now $5 in the money. That's $5 of intrinsic value that the Theta monster can't take away from you. And so that option that you bought, yes, there's an extrinsic value to it, but it's a very, very small percentage of things. And then while you're racing, or while you're climbing up towards that option you sold, Theta is on your side, helping eat away that extrinsic value of that out of the money option. So your strategy definitely very much could work. In fact, as soon as you kind of hit those max profits, if that's where you are when you can close it out, go for it, right? I mean, there's nothing to be gained by holding on to that any longer than you have to, because once you cross that red mark, and you reach your kind of max potential, that's not exactly right when you cross it, because there's a weird curve to that will happen, but it's not that far from it. And where you're breached on that definitely looks like something that could be in the full profit. And so that's great. You've hit it, and you're absolutely right. You have largely mitigated a lot of that Theta monster's risks if it's moving in your favor. But that Theta monster will get really hungry if this thing actually moves against the direction that you're playing.
Yeah, for sure. So real quick, super deep technical analysis here. We have the Theta monster. And this green line is what the Theta monster shall not pass.
Very nice. Very nice.
This is the highly sophisticated price action technical analysis that people come for. So let's bring it all home then. Okay, this is great. This all makes sense. What do we do? How do we find this stuff? So taking a quick look at this watch list here, the screener, I just did some really basic filtering. I did 10 million volume to basically no limit. One key thing on the filter here is I wanted IV. I wanted the IV rank to be over 50. So from 50 to 100 or beyond. Yeah, I selected to go over 100. So 50 and up is what we want for the IV rank. And that's basically all I filter for initially. And so we're looking at the Russell 1000 of market tickers. So what does it mean for something to be fairly priced or even underpriced? Well, it's the reverse. It's the exact reverse of what we would look for an earnings trade, where we want it to be overpriced. So we want the IVR, we want the implied volatility rank. We want the IVR to be less, we want the IV rank to be less than the HV, the historical volatility. So right here we have the HV 30-day. So we have the 30-day historical volatility, and we have the implied volatility currently. So of these tickers that hit that initial screening criteria, Oracle down here, 63.6, we're almost double our historical volatility. That's not great. And to kind of help visualize it, we have IVHV 30-day delta. So this just shows what the delta is between these two numbers here. So we pretty clearly see that Rocket jumps out here as a potentially prime candidate for this strategy, because the at the money is going to be very fairly priced, because the IV is 17.7% lower than the HV. So that's essentially how we screen to get into it, with the caveat that first is to go to the chart and get the trend direction and get the trend strength and the momentum and make sure that we're playing into that direction. Obviously we can see here, we get a little taste of that with the change percent. Rocket's up 7.36%. So it's clearly in forward momentum, upward momentum. So just hopping over to the options chain real quick. We can even see a couple interesting things. We can see the IV kind of fading off here, as we'd expect as we go down in time, down the options chain. But there is, on August 29th, there is this little uptick here from as we start to go down. So that's potentially an interesting place to shop. However, like I said, 10 to 15 days. Honestly, as we're recording on 8/13 here, it's fair to shop around either the 22nd or the 29th. For this, I already picked out some strikes on the 22nd, so we're just going to go in here and take a look. But notice on the implied volatility column here, at the money, which is price is currently $19.61. So our $20 strike is at the money. on the call side. So we have a 68.3% implied volatility. And as we go up the chain, we're actually increasing pretty significantly. And when we get to about that 15 delta, we see that, we have 81.38% implied volatility, and we can sell this option for 18 cents, and we can buy our at the money for 68 cents for a nice, cool, flat 50 cents, 50 cent debit on the spread. So initially, and this is going back to what I said before, that if we just bought the 20 strike, it's 68 cents. And so 68 cents off of $20, that puts our cost basis down around 1932, something like that. And that's where our break even is for what we had to pay for this. However, we get that 18-cent credit up here, so we actually bring that up to a 1950 cost basis, which is nice because that pulls us in a little bit closer to where we need to be. So visually, what this looks like then, if we take this trade right here and go drop it onto some analysis just to see the P&L, and this is where the strategy really is the power of the strategy is. And this is the power of any defined risk, really. But we have a $47 max loss because that's our net debit. And we have a $203 max profit. So 47 to 203, we're looking at a 431% max profit potential, which is not too shabby. So to me, that's really what makes this the most interesting is we have this defined, containable loss. And honestly, it's a risk to reward ratio. The risk to reward ratio is pretty significant. I did have one of these rocket trades. Like you saw on that chart, I had that one already on, and it has blown through into max profit scenario. I think if we go back to that chart, I'm pretty sure that happened just today. Indeed, it did. So again, reflective of how busy I've been, I didn't even realize we did that until pulling this chart out. I was like, oh, cool. Look at that. We're in max profit. So on market open tomorrow, like you said, Sprocket, we're in max. So there's no reason to hang on. The only thing I'll look at considering is how much am I actually going to buy back, of the Theta that still exists in this $19. But honestly, we're 2 days to expiration. So I'm guessing there's like 2 to 5 cents max in that, which is not worth, hanging on and letting this thing auto expire and auto assign and settle out and what.
One thing to keep in mind there when you talk about buying that Theta back, that Theta is going to be overpowered very quickly by the intrinsic value that you're up on your long option, because you get to sell all of that intrinsic value. So let's say Theta was, 10 cents. All you have to be is 10 cents above that red line, and intrinsic value of your long option will completely overpower that.
I see. So yeah, this one will probably close up tomorrow. I'm not interested. I just had a thought just now because, again, going back to what you were saying about the flexibility and how contained defined risk trades are a lot less flexible. This one, I feel like still nothing's going to be as flexible as what you just went over with your trade. But I feel like there is more flexibility here because I've taken 5 of these so far. Only one of them is in the red currently, which is not normal. That shouldn't be expected. This is intended to be, because that was I don't even know off the top of my head, a 5-to-1, 6-to-1 risk to reward ratio. So the intent of this is you're really leaning into that 6-to-1 reward ratio, which is I just got 6 credits to do this 5 more times and still be in profit, that sort of thing. So it is expected that this would have a lower than 50% win rate, because it is a directional bet. It is a directional play and all that sort of stuff. So I at least understand that of the wins that I have right now, shouldn't be expected. But what I've experienced on some of the other trades is there is some flexibility, and you have multiple chances to get out in profit. And so layering in different risk strategies of like, we're at 40% max profit, we're going to get out, or, taking 2 or 3 debits if it's in the portfolio sizing allocation, and at 40% we're going to clear out. You have that flexibility. The other thought that just came to me was, what if I rolled? What if I roll my $19 call up to something further and keep this trade going? I feel like that flexibility is there, but it was a spur of the moment thought that I haven't fully thought through.
Yeah. So just so you know, so when I talk about flexibility, I mean the ability to extend that to keep going forward. And that's really what the defined risk doesn't really have. And so you just mentioned rolling that call forward. Yeah, you could do that, but your put's gone. So now you have a naked call. And to keep that protected or keep that defined, you have to roll that put forward. Well, to roll that put forward, you're going to have to probably pull it up, because you're going to basically negate all of your gains by buying back all that intrinsic value that Theta can't touch. And so I think that's what you'll find when you explore some of that rolling ability. And lastly, I don't want to make it sound like I'm being negative on your trade, because if you can flip back to your tasty thing, what you're calling out is that risk to reward. You're 100% right. Like, you want it to be in that multiple of there, so you can get multiple iterations of this, multiple trades, because you're going to lose more than you win. But when your loss is so contained and your win is so much larger than your loss, that you can outweigh that. And when you look here at the tasty thing, one of the things that it does is it automatically shows you the probability of profit, or the pop. And in this particular trade, the pop is 42%, which, that's not in your favor. But if you put enough of those on, you can look at the statistical distribution there of seeing how, I'm going to lose $50 every time I lose. But when I win, I'm winning, 500% of that. One win can overpower those losses, and you start averaging that out. And you can see that a 42% pop with a risk to reward ratio like this will end up green overall, even though the win rate will be below 50%.
Yeah.
So that brings us to the end of this week's episode. Just a little bit of dabbling on what I've been looking into, kind of just a reminder of the tried and true strategy that I have and why I stick with it. It's nice to be reminded of that sometimes. And Viper's counterpoint here into what he's exploring is a beautiful example of that thing that I love so much about trading, is that you can do two completely different strategies that almost seem like they're completely opposite strategies. And both strategies can be a winner, because there's that much room in the market, and dabbling around and tinkering in it, and what makes you comfortable is really where the magic is the sea is so large enough that you can find your little niche, your little thing that you like. And all the mechanics that Viper is calling out is the exact, the yin to the yang of my selling strategy. Because with every push, there's a pull. With every pull, there's a push. And while I'm shorting volatility, he's longing volatility. He's looking for that explosive momentum. He's looking to get a discount by leveraging some of the selling volatility to get a cheaper price and a relative discount, where he's taking what would be $68 and he's picking up for $50. Right? That's a big discount on the sticker price of something. And so just understanding those mechanics and lacing all that stuff together into a strategy is what I think is just absolutely amazing about the market and trading and all of the different products out there, is that you can take these building blocks and you can build some pretty cool stuff. So hopefully you find this exciting as well, and you're dabbling out there and experimenting and exploring and learning. So good luck out there. Have fun. And remember, think outside the block.